Welcome back, everyone. Welcome to our concluding session of the virtual summit. We are really excited for the panel that we've put together today. The title is Why Timing is Critical and Now is the Time to Play Offense. And we have got three amazing panelists to be able to put on a great discussion for all of you today just around that topic. So I know they're going to be able to introduce themselves a lot better than I could introduce them. So Jay, how about you kick us off? Tell us a little bit about your background, where you are right now, and what your main area of investment is these days.
Yeah. Thanks, Alex. Thanks for inviting me to the panel. So I'm Jay Das. I'm the president and co-founder of Sapphire Ventures. We are a enterprise-focused growth investor with about 10 billion under management. Started out my career as a developer a long time ago. Had a little company, sold it off, and have been investing for the last 2 decades. Currently focused a lot of my time on infrastructure software, as well as data analytics startups, and increasingly looking at Web3 infrastructure software companies.
Amazing. Thanks, Jay. And then Kinjal, how about you go next?
Yeah, thanks for having me here today. My name is Kinjal Shah. I'm a partner on the investment team at Blockchain Capital. Been there for just under 5 years now. We're a multi-stage venture firm in the crypto Web3 space. And typically are generalists, although I specifically focus more on consumer Web3. And prior to that was working in traditional finance, but excited to be in the crypto world these days.
And we're excited to have you in it as well. And then Mark, how about you go last?
All right. Thanks, Alex. So I'm Mark. I'm a co-lead of our fintech practice at Index Ventures. We're a multi-stage fund across London and San Francisco, now New York, seed, venture, and growth fund. Same team across all three. We're more of a sector-specific focus. I spend, I'd say, 70% of my time fintech, 30% kind of B2B SaaS. Spent maybe a little over 4 years at a company, Stripe, before I joined Index, and did another few years in kind of the kind of more traditional finance, late-stage investing world before that. Excited to chat with you all.
Just some company called Stripe. Never heard of them, but yes. Let's just kick it off with, each of you have a pretty diverse background and also, pretty diverse investment thesis today. What do you think the next 6 to 12 months looks like for most of the founders that are tuning in today? From a financial perspective, from a startup perspective. Jay, how about you kick us off, and then love to hear from the rest of you as well.
Yeah. I think the next 6 to 12 months, every founder looks at it and thinks it's really uncertain, right? I think one of the big things is going to be is how do you get your customers to kind of pay for the products you're shipping them, right? If you're selling to the large enterprises, they're going to take time to kind of, pay for the procurement will be a huge challenge to go through. If you're a consumer business, there will be a lot more churn because, customers are not going to be paying all of these, all the services that they bought from you. So I think first and foremost, that is been told by everybody that you have to focus on operational excellence. So you have to focus on, hey, how much cash do you have? How much capital do you have for the next 12 months? Because raising capital in the next 12 months is not going to be easy. Although a lot of venture funds are sitting on a lot of dry powder, they are very, very reluctantly actually investing at the current time. And so the pace of investing has slowed down, and it's going to be very hard to raise financing in the next 6 to 12 months. So being cognizant about your balance sheet and having a huge amount of customer focus, because ultimately that's what you're building the company for, and your customers are who are going to pay the bills, not your venture investors. That is kind of the biggest thing you can do right now.
Maybe I'm happy to. So it's interesting. The last few years, they're a favorable time for founders to raise capital, right? Venture capital firms, different shapes and sizes. Everyone's been deploying capital at pretty unprecedented pace, especially in 2021. And as a result of that, a lot of companies found themselves pretty flush with cash, healthy balance sheets representing years of operating runway. But I think the interesting thing now is this doesn't necessarily mean batten down the hatches. You need to be cognizant about what you're doing. But if you actually look closely, a lot of our portfolio companies, they have customers that are actually still hitting or even exceeding operating plans. It's not like it's completely dire across the board. And it means that there are still customers that are very happy to use and buy products, but you need to be hyper focused on separating yourselves from nice to have versus I touch sort of the lifeblood of a company. I think that differentiation is becoming hypercritical and more critical than it ever was. But stay the course, keep executing your strategy, find true product market fit. It just might be more hyper focused on it. So I think, it's an interesting time, but it's not one without positives. It just you need to remain a little bit more ruthlessly focused.
Yeah, the only thing I would maybe just add is something, I think we talk about a lot with our founders is scenario planning and sort of widening the aperture of what the next 6 months could look like, what the macro environment might look like in 12 months, and then really just making sure that you have, a plan in sight for a couple of different scenarios, depending on how the macro environment improves or doesn't.
I like that a lot. Maybe we can dive deeper into that for a second. What does that, scenario planning look like? Like, what do you walk through with your founders, and what are some things that founders could do on their own to think through that process themselves? I
think, on a day-to-day basis, we don't necessarily want founders to be too worried about the macro environment. But of course, it has implications for their operations, and it has implications for their runway and really what the next 2 years looks like. So a lot of what we're doing is sort of scenario planning around what their runway looks like and what potential changes might need to be made if they do come to a scenario where they need to extend that runway, or building in timelines where they can perhaps fundraise at an earlier point than they originally would have, given that it might take a longer period of time. Really just kind of balancing out the fact that the future is uncertain, and sometimes it can be a little bit tougher than you might think today. And so sort of testing out, like similar to how you do a model of what exactly you need to do and what steps need to be taken. I'm sure others can add to that.
As you do that with your scenario planning, right? And if you look and find out that, hey, maybe we'll be tight on cash in the next 6 months, even, with some more efficiencies, you should actually go out and look for debt. There's a lot of credit available. There might be ways to kind of, if you are more early stage seed investment, maybe you can go do another safe or something like that, raise money that way. So, doing that planning and then figuring out how much cash you really need for the next 12, even 18 months, and figuring out how to get that cash is kind of something that all CEOs and founders should be doing right now.
Yeah, and maybe the other piece I'll add to this. So in a way, with our own portfolio, we sort of separated this into maybe, let's call it two camps. There's maybe the easier answer. If you have 2 or more years of runway, actually it's topical given the name of this discussion, the point is stay aggressive, right? Don't blindly cut spend, but be more strategic and deliberate about it. And kind of there's in a downturn, right? There's this favorite mantra of, hey, batten down the hatches, extend runway. But just that view is too myopic in a lot of matters. So if you don't need capital, or your business can raise given the KPIs you have, this is the exact time to be aggressive. Your competitors may be cautious, waiting for this storm to blow over. And this is actually the exact right opportunity for you in a competitive landscape. So that's the bucket of I at least feel comfortable with 24 plus months of runway. Then there's okay, maybe I have 2 years or less, right? Like it's a little bit more of a maybe difficult position, but even in that realm, the mistake is still often, I'm going to full keep the lights on mode. I'm nervous. What should I do? It's sort of a more nuanced, ruthless prioritization around. I think one of the things we push our founders on, how do you quantify what we call efficient growth? So $1 of marketing equals X dollars of top line. $1 of sales equals Y dollars of top line. Make sure you know the answer to that. And if you feel good about that, you actually know where you should be allocating your dollars. Just make sure you do it in a way that kind of is directly correlated to top line generation. When you think about product teams and how you prioritize there, maybe you have to eliminate what you think of as experimental or R&D type ideas. So focus your resources on what actually generates revenue right now. On the speculative side, unfortunately, in a market like this, you might do a lot of work, spend a lot of money to build a really compelling Act 2 or Act 3 product. Unfortunately, if you don't have top line to show for it, you're not going to get credit for that when you try to raise money. So that's one important nuance to keep in mind.
Totally true. And I think that leads into probably the next question I have, which is, what are things that you guys are seeing in the conversations that you're having with startups that they're doing well to anticipate some potential changes in the next 6 to 12 months? Or what are some other behaviors that you're seeing that founders aren't yet aware of that they need to be changing here shortly?
I can go first. So one of the key things that has happened is talent, right? I think last year there was a huge not lack of talent, but talent. There were everybody was hiring like crazy, and it was hard to unseat somebody from an existing company. But what has happened now, a lot of talent has realized that maybe they're in a company where the stock or the last round was done at such a high price or anything like that, it's not worth my time to be there. Like, I might just restart my clock and go to an earlier stage startup, or, or find a place where I have more ability to kind of make an impact. So I would say that this is a perfect time for founders to go out and look for talent, to find talent, and bring them on board. And this is where, one of the things that Mark mentioned, you have to be very, very operationally focused, right? Like you kind of have to understand, okay, what other parts of my business are working, what are not, and what are the talent in my company or the management team really needs to be replaced. And, you have to really hard nose about it. And I think you can find really good talent and upgrade the management team. So I would say that is one of the biggest offensive thing you can do right now.
Yeah, I'll second Jay's point on the talent. It is actually, especially, maybe skewing towards kind of I'm a pre-seed, seed, Series A stage company right now in this market. It is actually, we're seeing with our venture seed stage portfolios, it's a really good time to get people you thought were out of reach a year or two ago. And there's maybe two really key selling points. One, kind of the equity piece of, you might be at a mid-stage growth company that doing well, but raised 5 years ahead of what its current metrics really imply its valuation is in the current market. So you can get them with a compelling equity package. Or two, you can actually up level the responsibility they have. So you could find this young, hungry, let's say I'm VP of finance, you're bringing someone to a CFO role at a Series B company. That works too, because you increase the scope of responsibility. So just think of the different levers you have at play. It doesn't all have to be equity based, actually, for that matter, given kind of the difficulty people are having at kind of current stock option values. So I definitely +1 the hiring point.
Yeah, I think I definitely agree on talent. That's probably one of the biggest advantages. I think one other area that we're encouraging a lot of our portfolio to do is, and particularly given the crypto markets last year, is a lot of them have done, basically grown extremely fast, and really we're just trying to support the market demand, and now are taking a step back and just looking at their internal processes and their efficiency, and just making sure that everything is up to where it should be from a standards perspective, where last year was probably a little difficult to always manage that.
Totally. Mark, I'm going to direct a question at you. I know, Kinjal made a great point that we don't always want our founders to be, focused too much on the macro market. We kind of want them heads down, building what they do best. As someone who's heavily investing in fintech and B2B SaaS, those are both verticals that can be often, have a bigger impact from the macro. What's some of the advice that you're giving specifically to founders in those verticals right now for what they can do to prepare, or things that they can be doing right now that could be really beneficial for them?
Yeah. So I think it's being clear, this is going to touch on a few of the points we've talked about now, but every company, whether you're doing well, kind of in between, or kind of struggling to raise right now, we're telling them, let's do 4 or 5 things. I alluded to this earlier, but this kind of keep the lights on, and call it KTLO exercise. So more hypothetical than not, but if you pump the brakes on anything growth related or product development related, essentially anything you view as sort of capital expenditures, what does the health of your business look like right now? Are their underlying unit economics good, bad, or great? And what do you need to tweak? If in the nuclear scenario, you have to go into survival mode, given what's happening, are you going to be in good shape? So that's question 1. And then you can make your tweaks from there. Once you feel good about that, this gets into that quantifying efficient growth concept that I was talking about earlier. So again, into marketing, dollar into sales, what do you generate from a top line? If we went down a list of our own portfolio companies. If the answer is 1-to-1, great. You should probably keep pouring fuel on the fire. If the answer is $1 of marketing generates 30 cents of top line, we probably need to figure something out. And we're actually telling those companies either, is this a problem with your exec team on the go-to-market side? Is this a product market fit question? Is this a pricing question, et cetera? So you kind of figure out, let's find you diagnosed a problem, but what are the root cause? And then you help fix that. And that's maybe step 2. Step 3 is going to be around, this gets to that point of experimentation versus prioritizing what we call kind of core product. You need to focus a majority of your time on core right now. Core is important. Experimental can wait in a market like this because you'll have time to develop that over time. And then finally, the kind of last piece here is don't lose sight of quantifying or qualifying your milestones for the next round you want to raise. What are the KPIs that matter? What actually shows and demonstrates growth in your business? And that's going to be different for a variety of people, but you can kind of try to benchmark it, right? So burn ratio, somewhere between kind of 1-to-1, 1-to-2, maybe if you want to get slightly aggressive, be of good runway. Look at NDR. You want to kind of trend towards the 120% plus range if possible. And then in a market like this, funny enough, 2021, you kind of talk about 100% plus year-over-year growth. If you can survive this year with even 70% plus with solid NDR, good churn, and the right product market fit with good burn ratio, you're probably going to be in okay shape. So I think it's just a matter of kind of figuring out what people look for in the later rounds, given where the market dynamics are. So I think it's a good way to kind of prepare or feel prepared for what may come over the next 2-3 years.
It seems like a lot of it just revolves around taking a really honest look at the business and managing expectations for what you need to do moving forward, and just making sure you have a really good understanding of what's going on so that nothing becomes a runaway train down the line.
Yeah, exactly. And maybe the one other point I'll note is, I didn't want to get too fintech specific, but if, you did ask, hey, if you're a fintech company, look at this. So one component of fintech businesses, a lot of them tend to be very balance sheet heavy, lending heavy, and kind of reliant on interest rates, right? So you got to track that one way or the other. Some businesses, actually, it's a good thing. If I hold high deposits, the interest rate environment is actually great for me. So think of like a Brex or a Mercury or a business like that. Interest rates moving the direction they are, phenomenal. On the opposite, though, if I'm a business that's sort of a pass-through lender in a way, my underlying unit economics actually, I take money from a lender, then I'm a neobank of some sort. That could hurt my unit economics. So just again, you need to monitor that pretty closely. So interest rates in that macro are going to play a big factor right now too, depending.
Yeah, amazing. Great advice, Mark. Kinjal, I kind of want to pivot this over to you. Obviously, as your portfolio is heavily investing with blockchain, crypto, Web3, I'm sure some of this will tie into this fintech advice that Mark just gave. Some of it maybe doesn't apply. What is your take on what you're giving to the advice you're giving to your founders right now who are dealing in this space?
Yeah, I think, the macro environment is important, but not to be a real distraction, I would say, from day to day. Right now, we're really, really focusing on founders building heads down. In particular, this is not the first sort of crypto market drawback. We've had multiple over the past 5 to 7 years. So this is something that, I guess I would say founders are likely to be more aware that it's coming or could happen. And at the end of the day, even if the prices say one thing, I think we're seeing a ton of optimistic sort of talent moving into crypto. Tons of people who are building for the long term are not really worried about short-term price movement, as it should be. And so really it kind of helps better understand which founders and which builders are really thinking about the 10-year vision versus the 2-year vision. And that's really what we're telling them. And, if you want to be building a generational company or technology, keep that in mind, and then figure out what you need to do over the next 18 to 24 months to make sure that you can keep building towards that.
Totally Amazing advice, Kinjal. Jay, I'd like to kind of shift over to you as the person on the panel who has the most experience in the industry. You've been, working with at Sapphire and starting Sapphire since 2006. So you've seen all kinds of ups and downs. I'd love to turn our overall discussion also in more of a positive note. Obviously you invested in companies on the backside of a downturn and up into an upturn. What can founders look for on the other side of this downturn that could be really positive for them?
Yeah. Well, look, I think, grit and determination is always needed, right? And being operationally excellent and efficient. So I'll tell you the story of ExactTarget, right? I don't know how many people still remember them. They got bought by Salesforce, and the Marketing Cloud, Salesforce Marketing Cloud is over a $2 billion business now. This is all ExactTarget business. So we know the story starts for them in 2001, and they basically grew to about 70 million in revenues, and basically only spending 5 or 6 million in actual funding. And they were about to go public in 2007, and that is when the Great Recession happened, and basically the public market shut down. And this was a company that was cash flow break even. They publicly filed, confidentially filed, and were, for a year and couldn't go out. And 2008, we kind of came in and said, hey, why do you want to go public? Come back and, and take some more additional capital. We kind of bought out some of the folks who were, in the company for a long time. And, I think we invested about 150 million altogether with TCV and Scale Ventures, and, and enabled the company to grow for another 2-3 years. And it was a very successful IPO, and then an exit and M&A to Salesforce. And the story is that, look, if there is a business out there and a market out there, it doesn't matter when, and this is more for not seed stage, but, maybe mid to late stage in companies who are out there who are thinking, hey, my IPO now timeline is gone. I might never go IPO. But that is not the case, right? You kind of have to be focused on the business and make sure that you're growing, make sure that your employees are happy and there and motivated, and keep going. And there's always, the public markets will open up. And I think what we are seeing, the downturn right now, that will all go away, right? And at some point, venture dollars will come back, the public markets will all come back. It might not go back to the multiples that we've had in 2021, but multiples will come back up again. And, we'll have a whole slew of IPOs. So my point is that, in the journey of building a company, there's lots of ups and downs, and having that focus of not spending too much money, but having the customer focus and getting that done, is what it takes to build a great company.
Yeah, thank you, Jay. I mean, that story of ExactTarget is a great example of exactly what founders could look for, in these coming months and years. Mark, it looks like you wanted to jump in.
I was just going to say the fact that we're talking about, I hope people remember ExactTarget, even makes me feel old at this point. I was in banking when that acquisition happened, so it really brings back memories. But it is, I think, the maybe to echo that point, one of the ways I think about this is actually some of the best investments vintages of funds we've had at Index actually were basically on the back of the recession. So Adyen, Slack, for us in particular, those were businesses that people that, how is a payments company ever going to be that big doing a seed Series A in kind of 2010, 2011 timeframe? And lo and behold, that's still one of the best fundraisers we have today. So I think the answer is, don't let the macro scare you away from enduring ideas and enduring businesses, because you'll find a way to weather the storm. And in fact, actually, if you're an investor, this is the right exact time where you make the best investments come out of scenarios like this. So if anything, combine that with the amount of dry powder available, as Jay was alluding to earlier. If you have the right idea, right founder market fit, things should work out well.
Amazing. And so, Mark, kind of want to also follow up with that and maybe ask you a little bit about your experience at Stripe. What did you see, if anything? Obviously you were there during a time where they were crushing it. I mean, you helped them grow quite considerably. Were they doing anything at the time to also mitigate like what would happen if there was some downside risk to come their way? And what can founders do to, implement some of that themselves?
Yeah, it's interesting, right? So, I mean, it's funny, you spend enough time, say I joined Stripe kind of in around 2015, and outside in, things always look great for when a business is doing well, but you always say when you're under the hood, you're like, every business has problems, right? And I think one of the things that stood out to me in particular at Stripe was when I joined, we didn't really have kind of a good notion of how to credit underwriting was sort of a concept we knew we needed to figure out, but hadn't really thought through a ton of, for that matter. So there's actually, maybe I'll give a micro example and a macro example of this. So the micro, let's call it insurance policy, is sort of we came in and Stripe were paying users out. Actually, if you look at most of their contracts, I remember we're paying users out on a calendar day basis, not a business day basis. So you kind of go, okay, that's like, we're talking a difference of 2-3 days. Why does that matter? Well, I'll tell you what, Black Friday and Christmas make that matter a lot. So in times when, you have a bunch of people, e-com users on Shopify, heavy sales, if you settle, if Stripe pays their users on a Saturday, let's say, and is not going to get the funds settled from whatever bank they're working with until Monday or Tuesday, the amount you have to float between that 3-day period can actually be incredibly high in moments where you have Black Friday or heavy sales like that. So that was something we had to solve very quickly, because there was a point where Stripe almost outgrew the amount of money on its own balance sheet that you could float. So you actually had to come up with ways like a revolver with JP Morgan to figure that out. So that was kind of a fun now in retrospect telling the story, maybe scary at the time, but that was, one version of an insurance policy. So I'd call it the micro. Macro may be more relevant given kind of the markets right now. So, again, on that concept of kind of credit underwriting, you could think of, if reality, what is Stripe or what is, Brex in the early days, they're basically a basket or an index, lowercase I index of startups with various risk profiles. So in a way, it's almost like you're buying an ETF of, very volatile startups. And for businesses that collect funds in advance, but actually don't deliver a good or service immediately. So you could think of maybe from a hardware perspective, I'm a new headphone company, collected a bunch of money on Kickstarter, but I'm actually not going to deliver my headphones until 6 months later. There's heavy deferred revenue risk. And another good example of a service version of this, if I'm a concert, and I collect a bunch of money for tickets in advance, concert never happens. Another kind of like big credit risk exposure for a company like Stripe. So again, in a downturn, you see more examples like that of the business that collects a lot of revenue up front may go under, and you have a bunch of consumers left going, "Where's my money? I have a bunch of chargebacks." Someone's left holding the bag, and it's usually the payments company. So we had to kind of come up with a way. Yeah, it was also fun to tell the story, scary at the time. You had to think of a way. How do we think about reserves in instance? So you kind of come up with this, like, it was a bit of a rudimentary model at first, but I have a deferred revenue window of X number of months. Therefore, I can only pay out my customer 50% of what they're getting or 75% of what they're obtaining. And then I hold the rest of the funds as reserves until the good or service is delivered. So that's another kind of small nuance. You do have a business model change, but actually it helps a lot, right? At the end of the day, especially weathering the storms in a market like this. So those are probably two of the examples that come to mind.
I love that phrase. Fun to tell the story. It's scary at the time. I'm sure people love hearing that story. Terrifying for you, but I'm glad there's some insights coming away from it. And it also seems like your overall advice would just be like, try not to be the bag holder. And if you are, do what you can to not be that.
Yeah, I'd say it's more where are the leaky buckets potentially in your business, or where are you the most exposed in a scenario like this, and just figure out what is my insurance policy for that in that scenario is kind of how I think about it.
Yeah. Kinjal, with the Web3 crypto startups right now coming to VCs, obviously, as Jay mentioned, the amount of dry powder that's in the market right now, are you seeing them experience more difficulty because maybe people are viewing them as a larger risk as to other verticals? There's one question. The second is, how do you think that dry powder is going to be allocated down the line to companies within your vertical?
Yeah, I mean, I think we've seen the market sort of reset when it comes to broader Web3 and crypto valuations. There's probably still some room to go, which I think is great for the overall health of the market. But really, I think this is one of the most exciting times to be investing. A lot of founders that are really building for a longer term vision are raising for their companies right now, versus folks that maybe got really excited and into it, but then ultimately decided that this is not necessarily for them, and it's not for everyone. So I think being really clear about crypto is not always like the flashy headlines, but sometimes can also just be it's just a lot of hard work, and in terms of determining what product market fit looks like in crypto amongst the broader tech landscape. I think, in many different ways, crypto is still finding its identity in all these different subverticals. And so being prepared for that journey as a founder is, it's kind of like a whole new world. So I think that's something that we talk to our founders a lot about, and really just distinguishing the folks that are again, truly here to build for a longer term vision. I think that's really what we focus on. But in general, lots of dry powder. I think that dry powder is going to be beneficial to the founders that are building for the long term.
Yeah, great advice. I think as we've got 10 minutes left in our session, I'd love to kind of finish up with a few stories from you guys. I mean, we've already got a couple. Jay gave us a good one. Mark gave us some good ones, but some other stories about, founders that were either dealt a bad hand, time the market kind of just turned on them when they really wish it hadn't. What did they do to make this negative into a positive? What are some stories that founders can walk away with to help exemplify that?
I think one story that stands out to me is back in 2018, we made our initial seed investment in OpenSea. And at the time, Devin and Alex, his founder, were really excited about this idea that digital assets could play a role in games. And it was quite niche at the time that perhaps there will be a role for digital assets to either be in-game or digital currencies to be in-game. But what they really focused on was like a small group of users who are really passionate about this idea and servicing them. And it was definitely a market where, in 2018, 2019, you probably would not have predicted NFTs to sort of, blow up the way that they did in the past 12 months. But what they did was continue to sort of test out different iterations of what their marketplace looked like with this really passionate user base. And then they were sort of able to scale that out when the time came. But I think from their perspective, it was more about, okay, what is sort of like this crux of what's like this key insight that we have that we really want to follow through, and then be able to test that in a bunch of different ways until we start to see some broader market dynamics, which are really out of their control, shift in one way or the other. And so they really persevered through that. And I think that was just an incredible story of perseverance and really just trying everything until, really just like going for it. So I have a lot of respect for them. Yeah.
Great example, great story, and great company. Likewise, I feel like they've done just really well with everything that's happened over the years. And yeah, they've come out on the other side doing quite well.
I'll talk a little bit about valuations, right? A story about valuation. So we were an investor in Square, or Block as it's called now. And we were part of the round that was done pre-IPO round. And people don't remember, now they're very well established. They're a large company. People didn't believe in what Jack Dorsey had built. Like, people were saying that this is a dongle, nobody wants to pay for it, and it's going to go out of business. The metrics were all inverted. And the pre-IPO round had a ratchet. So it had basically a ratchet, which was that, that if the valuation of the IPO, so the round was done, I think around 6 billion. And that was that the GMV already at that point, they're over like 200 million in revenue, and I forget the GMV. So, but the IPO happened and it IPO'd at like 3 billion. So the ratchet really worked. And, we were all happy because, we came in and we got more shares at the IPO. And look, for the longest time, even the street didn't believe in it. If you go back and look at the metrics, they were trading at like 4, 5, maybe 6 billion. They didn't even trade at 6 billion for like 2 years. And then suddenly realized that, hey, look, what they are doing, they're tapping into a part of the business that is not being satisfied by credit cards. But more importantly, the tech that they had built in terms of understanding the loss ratios and being able to monetize that was like beyond what, was a really big competitive moat for them. And then it took off, right? The market realized it, and then they started getting these multiples. So the point of this story is that, look, at this point, as founders go through the next 12 months, they might have to take a round where, which has terms, which has, maybe that you don't like, maybe you have to take a little bit of a down round. But, at the end of it, if you build a business and you focus on the customers and creating a moat around what you're building, you will get rewarded. So don't worry about the short-term, valuation, that you might not get for the financing that you're trying to do.
Another great story, Jay. Thank you. Mark, not sure if you wanted to hop in another one or go for it.
Yeah, maybe I'm happy to give I'll give a quick high level one. But Obviously, I think, the Figma news recent came out, and that was actually so we were seed investors in that company from, this was back in kind of late 2013, and I think one key part of that story that you look at Figma and go, great, design business, everyone knows it now, but it wasn't always up and to the right. It took almost maybe 3 years for that company to really go
four
from
or five, I think.
Yeah, 4 or 5. Yeah, actually 4 or 5 by the end of it. By the time we're talking about real traction and the inflection, it did not, it was one of those companies that you kind of go, great idea, great founder, what's going to happen with it? And, I think the anecdote there is you can hit that inflection at any point in a company's phase. That inflection does not always come 12 months after you raise your seed round, right? So I think it's a good story of both macro and micro factors. A business, there's a lot of speed bumps, and if you keep adding, you find product market fit, that can come. So I think that's maybe the one piece worth highlighting here for everyone in the room.
Amazing. Yes. And that great recent example as well, Mark. Thank you. I've got one question from the audience, and then we'll wrap up with a final question from me. As we've talked about already a couple of times, there's the dry powder that's sitting around right now, obviously as a result of VCs being a little more potentially cautious, really longer deal times, all these different kind of things are contributing to that dry powder. What are things that founders can do to, either get in touch with VCs, reach out to, cold email? What are the kind of different ways that they can get in contact with VCs who are maybe more reserved? And what are some things that they can do to become more attractive in those pitch meetings, in those first interactions? Jay, maybe we start with you.
Yeah, look, I think, we all operate under a sense of trust, right? When you invest in a founder, you're basically trusting them with your capital to kind of build a business and do the projection. So I would say, and because, that there is, people are not sure about the projections and things like that. So I would do whatever you can as a founder to build a trust with the investors, right? So you kind of have to work with them, say, hey, these are the projections. This is how I am making operational efficiency in my business, and show them the results. And then, so build that thing. If you're going to need funding in like 6 to 12 months, start building that trust and the relationship with a core set of investors right now, and don't wait till the end.
Great advice. Mark, did you want to hop in on that one, or?
Yeah, maybe. So the other, oh, sorry. Can you hear me?
No, yeah, you're good.
Okay, great. Maybe I'll add a sort of, echo the trust piece, and I almost separate the kind of growth and early stage side too, to some degree. The growth side kind of go build trust in the fact that you have a grasp of the operational efficiency, how to grow your business, and you understand the whether you're a technical or non-technical founder, understand the kind of underlying unit economics and what really makes your business tick. Demonstrate that. Early stage side, maybe you have a little bit less up from a numerical standpoint to show, but I think especially the seed stage side, what I really want to see is, show founder market fit. And what does that actually mean? What in your background has made you passionate about this for years and years and years? And why, when the moment things get tough, I want to know that you're still going to iterate through that and not give up 6 months in, especially when the markets are the way they are now. And so I think that ends up being one of the most important things too at the early stage.
Great advice, Mark. To kind of wrap up, we've got just 2 minutes left. I'd love to end on a positive note. I'm sure there's a lot of founders here that are maybe more worried than they should be about the macro in the future. Maybe they just recently raised a round that at a quite high value, at a 2021 valuation, let's call it. What are the last 2 cents that you can give these founders to let them know it's going to be okay if they can grind through it? Just Jay, then Kinjal, then Mark. Just give your last kind of 2 cents on a positive note.
Look, I lived through like 2 downturns, the dot-com bubble in investing through that, and the 2007, the Great Recession. And every time you turn around, technology is what leads us out of these recessions or the downturns, right? So ultimately, all the tech companies that are, will be the ones that will get us out of it. And the positive note is you need more and more technology to run our lives, right? Software, AI, whatever you want to call it. So, and as Mark pointed out, this is the best time to start companies or double down. So I would say, actually, in some ways, for entrepreneurs and founders, this is the best time. They can hire talent. they can be more efficient and, and go build great companies.
Yeah, I would just echo that. I think zooming out and looking at the history of Silicon Valley and tech more broadly, you'll really notice that the valleys are sometimes the greatest opportunities to go build and really build with a certain type of discipline that can be slightly different in bull markets. And so continuing to push on that and really encourage founders to think of this as an opportunity to go build something amazing rather than, a negative.
Yeah, and so plus one both of what Jay and Kinjal have said, so I won't add too much to it. But maybe the one thing I'll say is, interest rates, macro environment, they don't determine product market fit or building lasting companies. So, think through the bottoms up what really matters. And if you're selling a product that is meaningful and your customers are willing to pay for it, they're going to pay for it now. They're going to pay for it in 2021. That doesn't matter. So I think that just, if you build something strong, people will come by it. So don't worry about the macro to that degree.
Amazing. Jay, Kinjal, Mark, thank you all so much for this great panel. It has been honestly just a pleasure to talk to all of you. And I hope the founders listening in right now took away some great advice.